This is our Forex blog for April 22nd, 2013. And like we do most days, we start with our currency indexes because this is the easiest way to trade. It lets you see the trend. You know whether to be buying or selling. You also know where to get in and out of trades. And you also know exactly when markets are likely to continue or reverse. And basically this is the dollar index, the yen index, the pound index. It's basically a synthetic chart I created showing what all the euro pairs are doing, all the dollar pairs, all the yen pairs. And it gives you a wealth of information. You can see the previous day's high in the dollar index, the previous day's low, hourly moving average in gray, 15-minute moving average in green, the point of control of the previous day. This is where most traders have positions, and this is for Friday, so that's why it's underneath Sunday's low. This is Friday's most actively traded price in the euro. You can also see that it went up 18 pips. So while the euro basically was underneath its hourly and likely to go down, it's likely to find support here. Knowing that Friday was an up day, it's very likely to find support here and bounce. If you saw that this said down 10, 15, or 20 pips, it's less likely to get support here and bounce like it did, and you wouldn't necessarily want to buy it, and you'd be more apt when it broke down right here to sell it, knowing that the previous day was up 18 pips from the previous day. You know, when it broke that level here and you sold, you can see that trade failed. Why? Because the point of control for the previous week went up 33 pips, and the previous day went up 18. So both the week as a whole and Friday was both an up day. So in an up week, so you know. Also, this gives you a wealth of information such that between the hourly moving average, the weekly point of control, daily point of control, it's very likely to be a very choppy market. And you can see it was today, up, down, up, down. Basically wait for this area to get broken right here, and then you would sell the Swiss because it's likely to go down. Now it's not likely to go down a lot because you can see last week went up 69 pips, previous day went up 14 pips, and you can see also the daily and weekly trend underneath here. Now for those of you who like our old currency meter, which we've done for 6 or 7 years, it shows you statistically how strong or weak each currency is. You can see the daily trend, weekly trend, and monthly trend underneath here, combined with actually seeing the chart. It's incredibly useful. For example, you can see trend lines, and as long as the market's, I drew that on there wrong, as long as the market's above that trend line, you would basically want to continue looking for buys. And if you see a false breakout over the previous day's high and it comes back down, you can use that trend line as a profit target. And later in the day, if that trend line gets broken, it's a big sign that the market's going to go down. You can see it did on the retracement, it went down, on the retracement, it went down, then it went sideways. So trend lines, being able to draw trend lines on these charts is incredibly helpful and useful. And it also can help you predict reversal areas. For instance, the euro is trending down. If you draw a trend line on here and you right click on it and duplicate it and you project that off the low, well, guess what? This is an area that's likely to find some support. Given the fact that the previous day and week was both up, this is a good place to be looking for buys if you expected a bounce, and guess what? It went up. So what I'm trying to say is, if you know how to use this, it is very accurate and very predictable, not only in terms of finding a profit target if you're short right here, but also getting out of your trade and doing a little smaller counter trend trade. Watch the same exact thing here. It's trending up. You right click on it, duplicate, project that from the high. Where did it stop at? At 10 o'clock. So at 10 o'clock, let's say the pound, it would be much better if this was trending up today, but the longer term trend was down. You can see Friday was an up day. You can see the weekly trend, monthly trend all shifted up. But if the longer term trend was down, sometimes you have counter trend days up. This is an excellent high probability place to sell. At 10 o'clock, which currency was likely to find a bottom and go up? So let's take a look. This one's trending up at that time. It's 10 o'clock. This one's kind of going sideways. 10 o'clock. This one's in a downtrend. The strongest of these four at that time was the yen. You can see the statistical intensity. So at 10 o'clock, this was a pretty high probability place to sell the pound because it's likely to go down against the yen that was very strong. You want to sell the weak ones versus the strong. So let's move that chart out of the way. We'll bring up the pound yen chart. 10 o'clock, we're looking for sells. And guess what? Here's 10 o'clock. A little bit before that, the price broke from above to below the hourly because you saw in that other chart that the yen was going up. 10 o'clock, you're looking for a sell. 5-10 minutes after 10 o'clock, it breaks down through the lows. Draw your fibs off of this. You got your fib targets down here, and you put your stop above the bar's high. This is what your risk is. You have a good chance of making significantly more. And you can see it went right to the lower containment band. Our perfect oscillator hit an extreme 80 level reading. Usually when those happen, you get a some kind of a bounce off of it, whether it's 5 to 20 pips or down. You can see at the high here, that was the end of the move. Those were the only times of the day where the perfect oscillator hit this extreme. This was very close to it right here. And you can see the price immediately fell 15-20 pips. So that's how you can use these tools to anticipate what is likely to happen. It's that simple. Let's look at all of them again, and we'll just scroll back and take a look. You can see the Australian couldn't get above yesterday's high, so that's one sign of weakness. Came down and found support at the hourly moving average, but couldn't break it. You see the last week's average price right here, and it was down 175 pips last week. So last week was a big Australian down week, and so when it breaks down right here at 330, a phenomenal one to sell. All the time frame trends are lining up. So which one's the strongest at that time? Well, the dollar's right near the previous high. I would go with that one. And it also has a daily and weekly trend that's up, whereas the yen at this point, it becomes strong later in the day, but the daily and weekly trend's down. You can see that on Friday, the most traded price of the yen, of all the yen pairs, were 130 pips down. So you wouldn't at that time look to sell the Australian yen. You certainly could, because this one's above its hourly and so more likely to go up. If you sold this against any currency that was above its hourly, probably made money on most of them. But the strongest one at the time was the dollar. So around 340, we're looking to sell the Australian dollar. And it was probably, when it was starting to go down, it was probably right around this time where you would have saw that. If you looked at this chart, you can see it wasn't able to get back above hourly. This is a big sign. It's a filter. Underneath the hourly, focus on sells. Above the hourly, focus on buys, and it tends to act as a major resistance area. And especially when currency trends down, the first time it comes up in this area, it's a pretty high probability place. 330, if you're watching this chart, you would have sold it right here because you can clearly see its nice little wedge pattern right here. But even if you got into it a little bit late, you can still see it fell about 18 pips. And guess what? Hit the extreme low here and got a bounce. This one hit right here, got a little bit of a bounce. You never, or you're not always going to get a super huge bounce off of that, but an extreme here, pulled back. Here was high, it kind of went sideways. Right here, the market didn't really get much of a bounce, maybe 8 or 9 pips, but it went sideways for an hour or so. So the perfect oscillator really lets you kind of know what's going on with the currency. You're not always going to get huge moves. You can see that this one fell a little bit and then stopped, whereas the dollar really failed to break out here. Again, if you had sold the Australian versus the yen, which was kind of going sideways, it probably would have given you more pips in this case at 340, and not quite. But you can see it came back up to the hourly, couldn't get above it, broke down from here. You got a nice little wedge pattern here too, and that was the beginning of this big move from 7 to 10. If you look at this from 7 to 10, look what you see on here. This one did a retest back to the hourly, great place to sell. Notice here again, and from 7 to 10, the yen came up to this resistance area, couldn't go back and below it, and around 9:30 right here, broke out. At 9:30, this one was just kind of inching its way down, but it kept going down. If you drew a trend line, off of those bars high, you stayed with the trade, and it's that simple. And this kind of forces you, it's not hard to stay with. A lot of traders lose money because they never have big wins. They have sometimes 5 to 10 pip losses, 5 to 10 pip wins, and then whether they win and make money or lose money comes down to what winning percentage they are. That's a hard way to trade. It's much better to try to get 2 to 3 times bigger wins than losses, and always take small losses. Move your stops to break even once it goes 6 to 12 pips your way, and that way you have a ton of break evens, small 3 to 10 pip losses, and a bunch of 5 to 50 and sometimes 100 pip wins. If your average win comes out to 20 to 30 pips and you're losing 6 pips or 7 pips on average because of all the break-even trades lower that loss, then you're going to do very well. And you don't have to be even 50% winning. You can be 35, 40% winning and still make money. So you can take a stab at every trade and the ones that work. Notice also with the yen, when this thing's going up, just draw your trend line off there, and boom, guess where this thing broke? It finally broke its trend line. Guess what? The weekly trend's down. This is a great place to look for counter trend sell up here at 11. Which one's likely to go up when the yen's likely to go down at 11? A little bit after 11, you can see the euros pop in here. So somewhere around 11:30, great place to buy and anticipate, very easily anticipate, the euro yen. Here's 11:30. Notice we went down, hit the lower band almost to the pip. Extremes, very close to an extreme. You actually have a divergence trade here with slightly higher low, and also the same reading here. It's showing that it's not as weak. In fact, it wasn't even able to hit the lower Bollinger Band of this indicator. Throughout the day, on almost every down move, here, 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 it hit or went below the Bollinger Band on here. This time right here, it didn't. So guess what? It is losing its weakness. And so at 11:30, when we're looking to buy a bounce in this, because the euro is likely to go up, the yen, remember, broke the trend line there. You might have, whoops, I didn't mean to draw that. You might have had a trend line on here, and it broke it, and this gave you the confirmation to do so. A series of higher lows on the perfect oscillator, which reads the statistical momentum. You get into that trade right here, and when it hits the plus 80 level, you might want to get out of half your trade and just kind of see what happens when it fails to make higher highs. You get out, but nonetheless, you'd probably be in this thing around 35, out at around 65. You made 30 pips while risking a very tiny amount. You risk here, and as soon as it starts going up, you move your stop to break even very quickly. It's that easy. You can anticipate a very high percentage of the time what's likely to happen in the future by using trend lines, wedge patterns, double tops, double bottoms, the previous day's high, hourly moving average, 15-minute moving average a little bit. I don't use that one myself that much. That's why I rarely ever teach it in class. And perfect oscillator can help you time and see if a currency is getting weaker, keeping the same weakness or strength, or the momentum is changing.